It's about creating a life not limited by money, and how you get there is save more and invest smarter.
This is The Payoff with me, Sylvia Jeffries. Ben, welcome to The Payoff. It's so great to have you here.
Good to be here.
So I've been following you for a while, and I've got a lot of questions to ask you because you do such a great job of breaking down really complicated things for those of us who haven't grown up in the world of finance. But my first question to you is, what is the most common question you are asked in your DMs?
I think the most common one is actually, if I've got $10,000, what should I do with it? I've lost count of the number of times that I've been asked that one over the years, and the answer is always the same, that it depends, because it depends. Is that your only $10,000? What are your plans? What are you looking to do? What's your income? Are you in a surplus? All of these sorts of things. So unfortunately, it's not something that you can answer simply, but I suppose it's to the point is that people just want to know what are the smart things to do with their money. But I also think that that's a challenge for a lot of people as well, because a lot of the people that listen to this podcast and a lot of people that view our content, they have options, and there's a lot of good things that you can do with your money. It's often that people aren't choosing between something good and something dumb. It's just that they're trying to choose between four good things, and that actually makes it harder to make a choice. So, hence the content.
I guess that quandary of what do I do with $10,000 probably applies to a lot of people maybe in their 20s, 30s, even early 40s, who might still be working towards their first property. And I know that's an age group that you've really targeted, that you're focusing on at Pivot. Why are you focusing on people in their 30s and 40s in particular?
Well, when I first started in financial advice, I worked at a fairly traditional money management company, the sort of like mahogany desk type suit and tie deal. And for those people, they were great advice and great help for people, but it was all help for people that already had quite a lot of money. And the standard line was that, because they did a lot of marketing, and they would get a few young people that would come in from time to time. And generally the line that we were told to tell those people was that come back when you've got $100,000, or come back when I think it went up over time to $200,000. And it used to it didn't sit right with me, because I know that it's not as easy to do that as it is to say to do it. Like, everyone knows great, get $100,000, but how? And then, what's the best way to actually get there? And so, when I left that company, I went and worked with a small company that was working with a lot of first home buyers, and they were doing some great work primarily on the mortgage broking side of things. And I got brought into that business to build the advice offering for those customers, and I could see that there was so much potential for people if they were a little bit smarter and a little bit more dialed in and kept a little bit more accountable to what they were doing, to actually make much faster progress. And so that really, I got a lot of fulfillment out of that. It was great to help my old clients save $100,000 in tax, but it was probably more fulfilling to help people save that $100,000 and get into the property market, or be able to start a business or start a family, and those sorts of goals. And being a bit younger myself, then I could sort of identify with the challenges that those people were facing at the time. And so when I started Pivot Wealth, I wanted to create something that was able to support those people, but also to build a business that wasn't like linked to any of the banks and didn't have some of those conflicted payments and fees. I think at the time that we started the business, it was there was fewer than 1% of financial advisors that were a pure like fixed fee model, where it's like, and we still charge to this day, it's a fixed dollar-based fee, and there's no like asset-based fees depending on how much you put in your super fund or your investment account,
so there's no sliding scale
commissions and those sorts of things. There's tiers of service that if you've got more, if you've got $10 million or $1 million or $100,000, there's a different level of complexity, and so there's a different charge rate that broadly applies. But for us, that doesn't make any difference whether someone puts all their money into a bank account or their super fund or an investment account, or buys a property or pays down debt or anything else. And so, I was quite naive at the time, but it really did connect with the market, and then we started getting some good results with clients, and that built some word of mouth. And 10 years later, it's the momentum has sort of built, just continue to compound from there.
I want to be honest, and please know that this is a compliment. You don't look like your typical finance bro.
Yeah.
Like, there's no puffer vest, no checkered shirt.
Yeah.
You've got a cool fade. Did you always feel like a bit of a square peg in a round hole in the industry?
Well, I think I was probably a round peg in a round hole a little bit, like when I first started out.
You
Although
used to wear the puffer vest?
I didn't wear the puffer vest, but I did wear a suit and tie. That
Yeah.
we had suit and tie. No, wasn't allowed to grow a beard or anything.
Yeah.
And when I left that first company, the traditional one, and went and worked at the small business, I immediately grew a beard. That was my small company beard. And then when I left there and started my own company, then my beard got a little bit longer, and that was my self-employed beard. But I don't really like wearing suits, and we do a lot of work with tech professionals as well, and that actually made it quite an easy transition, because if you talk to software engineers and computer coders, I feel like they've really changed the landscape a little bit from a workplace perspective, because those people, super intelligent, doing incredible work, they're doing that work in a t-shirt. And so I think for me, it was something that we put our brand message out there, and I fully appreciate that doesn't connect with everybody. But we wanted the people that come to us to be people that respected being approachable and being genuine and who we are. So I don't know, maybe the puffer vest will come someday. There's still time.
It's still a little chilly out there, isn't it? So your sort of mantra is get rich slow and stay rich forever, right?
Yeah, essentially it's about creating a life not limited by money, and how you get there is save more and invest smarter. But it is getting rich slow over the long term, that there's not a lot of shortcuts when it comes to money, as much as I would love it personally if there was, and as much as a lot of the people that we talk to would as well. But often the times, and unfortunately over the years, I have seen quite a lot of people that have ended up making some significant financial mistakes and suffering pretty significant setbacks. And commonly that comes when people are trying to cut corners. They're trying to do the quick thing that gets quick results, but the way that finance works is that the higher the expected return, essentially the higher the risk that's with that. And there may be 1 in a million people that get lucky a little bit and they do, get rich quickly. But for that person, there's, hundreds of thousands of other people that have blown up all their cash and have to go back to the starting line. And, there's so much psychology that impacts how we think about money and the decisions that we make with our money. I've nerded out on that quite a bit over the years, and particularly when I started writing books as well. And I came across this study, which I can't remember the specific details of it now, but where people tend to remember these success stories a lot more than the downside stories, because everyone thinks, it won't happen to me, or that person got unlucky or something like that. But when you hear about someone that put $1,000 into a stock or a crypto project and made $10 million, that sticks with you, and everyone, because we really want that, it sort of leads you to make suboptimal decisions. And so I think for young people in particular, that they often don't realize how powerful it can be to just get started, start small, and be consistent over time, that you can create millions and millions of dollars from just investing, $10 a day or $20 a day or something like that. But people, they don't recognize that, and they might do a little bit of investing, they do a bit of dabbling, and then they're 3 months later, they're not a millionaire yet. 6 months later, still not a millionaire. And then they get a little bit frustrated, a little bit fed up, and then they give up, but then they don't see it through to actually get the compounding. And so I think a really big thing for people, if you can just set the right expectations when you invest and look at what will happen if you just keep going over the longer term, people are often blown away. It's still one of the most powerful things that I show people with our content, just a simple compound interest calculator. We use the one on the Money Smart website. You put in, an amount of money, do it consistently, and then watch it grow. And you get some pretty incredible results with not a lot.
Yeah, so what can be the difference between, saying investing a small amount of money in your 20s and starting in your 20s as opposed to investing in your 30s, starting in your 30s?
Well, it makes a huge difference over time. I put out some content on this. I don't have the exact numbers with me, but from memory, it's something like that if you wait 10 years to invest, you need to invest double as much to get half the result.
Wow.
So if you were to invest an amount and start today and end up with $1 million, that you would need to invest double just to get to $500,000 if you start 10 years down the line. So
I wish I could go back to my 20s so
do
bad.
I. Yeah, I was just chatting to a guy in our office today that works in another business in there, and he was saying he just gave one of my books to his 20-year-old son, and I said to him, I wish that when I was 20, I was dialed in enough and motivated enough to be on the front foot with that. I think money's a little bit more out there these days, and thankfully there are more people that are dialed in and focus on this stuff. You can still do it if you wait until your 30s and 40s. It's just that you just need to do a bit more. To end up in the same position. And I think a lot of people think, I've started too late, or I wish I did it in my 20s. But then they don't do anything, and then they waste even more time. And it's like, well, you're just going to have to either sacrifice more in the future or settle more. So no matter where you are and how young or not young you are, the best time to start was always 10 years ago. The second best time is right now.
So with that in mind, how does your 5% rule work? How would that apply to a 20-year-old?
Yeah, so the 5% rule basically says that you can draw an income from investments of about 5% without eating into capital. So what that means in human words is that basically if you've got a pool of money, that you can draw about 5% of the total value of that money each year for the rest of your life, essentially inflation adjusted in perpetuity. So that means if you've got $1 million in, say, a share portfolio, that will give you an income of about $50,000 every single year for the rest of your life. The reason that works is because the long-term return on the share market is about, in Australia, it's about 9.8%, slightly higher internationally. But you essentially get the 9.8%. You can take off a little bit for the fees of whatever your investment is, a little bit for inflation, and you're essentially left with 5% that you could spend and still have the value of that money preserved in today's dollar terms, even after noting that the cost of stuff is increasing.
So you're talking about drawing out from that investment rather than necessarily collecting dividends or something.
Yeah, it's that. Well, the investments will generate you some dividends depending on what you're invested into, and so taking the money out may be the dividends that you've earned, or it may be some or all of them, or it may be all of the dividends and then a little bit of the capital that you're taking off the top. But it should be that, because if the return's 10% a year, then your $1 million should earn you about $100,000. You spend $50,000 of the 100, and then the other 50 goes in to protect you for inflation over time. And you should still have about $1 million in today's dollars in 10 years' time, 20 years' time, or 30 years' time. So it's a powerful way to set targets that if you want to replace your salary, with investment income, and that was the focus for my second book that I put out.
Literally wrote the book on that, yeah.
Yeah, which has been great. I was surprised how much that message connected with people, but I've spent a lot of time thinking about money and realized that replacing your salary with investment income essentially is the definition of financial freedom or financial security, a lot of the labels that people put on it. But replacing either your current salary or your ideal level of salary with investment income. And if you can do that, then you're working out of choice as opposed to necessity. And for a lot of people that I talk to, they don't necessarily want to retire. They enjoy what they're doing. They enjoy being productive and doing all of these things. But it's about being able to work out of choice rather than necessity. And if something changes in your personal situation, your health situation, your family situation, and you want to step back or work less or go work for a non-profit or volunteer your time, then you've got the ability to do that.
How long do you think it would take? I mean, how long is a piece of string? But how long would it take someone to be able to replace their salary through their investments?
Well, it depends on how old you are when you get started, essentially, because of that compounding effect that we were talking about before. But essentially, as of today, the ABS average salary across the country is about $100,000. The median salary is obviously a little bit closer to about $65,000. But just using that $100,000 target, we can use the 5% rule to say if you wanted to get an income of $100,000 a year, you'd need to have about $2 million in investments to give you that income forever and a day, essentially. And so if you're 20 years old today, you'd need to be saving and investing around $10 a day to end up with $2 million by the time you reach age 60, and then you've got your $100,000 a year income. If you're 30, then it's about $30 a day. So you see that's the difference of 10 years. You're basically investing 3 times as much to end up in the same position. At 40, it's $90 a day. So you see it's cranking up quite a bit. And at 50, it's about $335 a day to end up in that spot. And so for most people, like $10 a day, that's something that should be achievable. Not nothing, but coffee and a half, depending on.
It's less than a schooner probably now in
Probably.
Sydney's eastern suburbs.
Yeah, exactly. $30 a day is probably still manageable. That's $210 a week though, so it's getting bigger. But at $90 a day, you're talking about $600 after tax dollars a week, and then investing that, and then at $335 a day, like most people aren't earning that much money, let alone have the ability to save that after they clear their tax. So that's what I mean when it's like the sooner you start, the less you have to do to end up in the same position.
ETFs, index funds, they've really changed the game when it comes to investing in the share market and made it a lot more accessible for novices who may not have the time or the capacity to track the market day to day. What are the foundations of a good ETF? What do you look for in a good ETF?
Well, I think that probably the main thing with any sort of ETF or managed fund or investment fund that you're looking at is what is the mandate or the overarching strategy of that fund. And so you mentioned index funds. So the job of an index fund is to track the overall share market. So the job of an Australian index fund, whether that's an ETF or a managed fund or whatever wrapper you put on it, is to invest in every single company in the share market in the same proportions that company makes up the market. So for example, the big banks are some of the biggest players in the market. So in an Australian share index fund, that's going to have the biggest weighting will be into the banks. And so if you had an international fund, then again, an international index fund, then its job is to do the same thing, but do it across multiple countries. And so in an index fund type context, there's very little difference between any of the Australian share index funds that are out there because they are all essentially doing pretty much exactly the same thing. And so I see a lot of people that they get so caught up on that decision because there's a number of different Australian share index funds out there, but they're all almost identical. So you shouldn't really waste any time thinking about whether one is better than the other. Just pick one and go for it. But a bit of size helps in that that they've got a level of scale in that it's got security, and how long a fund or a fund manager has been around for is another thing as well. But I think we're really fortunate in Australia that we have really strong investor protections through APRA and ASIC, and the process of getting a fund or an ETF listed on the stock exchange is incredibly rigorous. And so from a security perspective, you do need to be really careful with what the funds are investing into. But in terms of whether you're using different fund providers, then the security levels are really high as well. You can have other strategies for ETFs and investment funds as well, what's called actively managed funds, which rather than tracking the overall share market, they are trying to focus on doing better than the share market typically, or doing differently to the share market. So for retirees, for example, you might have a fund that has a bit more downside protection if the share market goes down, or a little bit more income or something like that. That's a little bit harder to, a little bit more complicated for an investor that's trying to assess, which ones are better, because there is quite a level of complexity there. But I think for anyone, index funds, I think, are great. And obviously this is not financial advice, and you should seek that out. But you mentioned that they're great for novices, but I run a financial advice business, and the vast bulk of our clients have their money invested into index fund, either ETFs or managed funds, depending on what their strategy is. So you really don't. Sometimes people talk to me through the content and they're saying, when do I graduate, or when's the need to do something beyond an index fund? And I say there isn't. We've had clients that have multi-million-dollar portfolios that it's entirely in index funds. Wow. And they get incredible results. And I think with investing, there's a lot of different ways to be right when it comes to investing, but also the numbers don't lie, and the statistics say that index funds perform better than non-index funds more than 80% of the time. And in some categories, they look at it by category, like Australian shares or big companies, small companies, but in some categories, it's more than 90+% of the time. And so that's comparing the whole market of professional investors around the globe, companies and individuals that have almost unlimited resources to try and pick the investments that will perform best. And if fewer than 20% of those people can do better than an index fund, you or I or anyone that's listening, you're really hoping to get lucky to do better. And so yeah, the numbers don't lie.
Yeah. I mean, I'm not going to outperform Warren Buffett, am I? So just
Well, he's a big believer in index funds
exactly. Yeah.
as well.
Yeah.
And so again, if you see people that are that successful doing that, then they're obviously they're onto something.
They know what they're talking
Yeah,
about.
exactly.
If you're all in on index funds, is there still a need to rebalance every now and then?
Well, it depends on what sort of index fund you use. So if you were to have, say, an Australian share index fund and a US share index fund, then you over time, if the Australian share market does really well and the US share market lags behind or vice versa, you probably find that the composition of your investment portfolio would get a little bit out of whack. Say you were trying to be 50-50, then one's going to be bigger than the other. And if that goes on for very long, then that can become a little bit imbalanced. So in that situation, if you wanted to maintain a 50-50 allocation, that over time you would probably need to do that. There are a number of index funds, though, that have come out in recent years where they'll have Australian share index fund, US shares, and international, and even some that have like property index options in there as well. And the really good thing about those funds is that they do all the rebalancing for you. So you're just buying one fund, so it's nice and simple, and you pay lower like brokerage costs if you're paying even a few bucks to buy an ETF. That can add up if you're buying 2, 3, or more ETFs at once. But then they consistently just rebalance the allocation, so you don't have to really do too much as well. So it's a nice simple way to do it.
Okay, what about property? This is a topic that is highly emotive for young Aussies. This is the area where they truly feel locked out and left behind, I think, by previous generations. In one of your recent posts, you said you can buy a house with a $30,000 deposit.
Yes.
Is that for real? How can you do that?
You can. Well, there's housing affordability is a real challenge for a lot of people, for sure, and it's definitely not easy. If you look at the income ratio to property values, that it's changed since the 80s and 90s, where it was like 2 to 3 times the average income you could buy a property for. Today in Sydney, we're looking at about 13 times. So it's a lot harder. That means it takes you
insurmountable for some people.
It definitely does, and it means that it takes you a lot more years to get your property deposits together, and definitely a lot more to actually pay off that debt and become debt free, which is the ultimate goal. But the government are clearly aware of this issue. They know that it's a pain point for a lot of people, and they have done a number of things to support first home buyers and make it a little bit easier. And so these are state-based schemes that depend on where you are, but there are some national ones as well. One of them, which is quite powerful, is the first home deposit guarantee, which basically allows you to buy a property with only a 5% deposit. So that means that you can purchase a $600,000 property with only $30,000, and you're not paying any lender's mortgage insurance, which
the government's covering that.
You typically pay. Yeah, the government give you the guarantee essentially with the banks, and there is a limited number of slots available, and there's some income caps that come with that. But it means that you can use a lower deposit amount to get into the market. And if you combine that with some of the stamp duty concessions, so in New South Wales, you can purchase a property, and if you're purchasing at that $600,000 level, you're not paying any stamp duty either, which is a pretty significant cost of getting into the market. Within New South Wales, it's about 4% of the property value otherwise, so it's pretty substantial. So that allows you to essentially get into the market if you can access those schemes, and there are different ones for different states. So it's always worth having a good mortgage broker in your corner, or someone that knows the rules. And then that's a starting point. Like, that's, for a lot of people, it's probably unlikely to be their forever home, but at least you're then getting into the property market, because we seem to have, and there are periods where the property market does go down. We've seen that a couple of years ago as interest rates went up as well. But if you look at it over a long period of time, the property market just continues to increase, and those periods of downturns are few and far between. And so what that really means is, for anyone, by waiting, it just means that you're paying more to get the same sort of property. And even if you ultimately want to end up in, say, $1 million property, and you start with a $500,000 property, at least you're halfway into the property market. That if the whole property market doubles, your $1 million property will double to $2 million, but your $500,000 property will double to $1 million, and so you're still only halfway behind as well. So it can be like a stepping stone to get there.
And you're starting to grow some equity. And another topic that I've seen you speak a lot about is using that debt to build more wealth, because I think there's such a negative connotation around debt, and we feel like it's something that we're saddled with. But you see it as a way to build wealth. How can you effectively use what you've got there with debt?
Well, I think borrowing to invest is one of the most powerful ways to get ahead. You definitely need to manage your risk and be careful with your planning and all of those sorts of things. I do think that's absolutely critical. So you don't want to just do it or have rush some back of the envelope calculations and hope for the best. But if you say you've saved up $50,000 or even $100,000, you could choose to get that $100,000 and invest it, say, into the share market, and you'd have $100,000. Maybe you go and buy a nice index fund portfolio, and you're going to benefit significantly from compound interest over the years ahead. But if you got that same $100,000 and use that as a deposit to purchase a $500,000 property, all of a sudden you've got an asset that's 5 times bigger than the share portfolio. And so, and I'm assuming that you've chosen a good property and you're comparing that with good shares, but a good property that's 5 times the size of your share portfolio is always going to win over the longer term. And so it's like the borrowing to invest allows you to invest more money than you can with just your savings alone. And that's why when we do these financial plans for clients, we do this quite detailed scenario modeling where you put in all of the baseline, and we've got time off work, starting a family, daycare costs, and all of these things. And then you start to look at, well, what if the different pathways in front of you? What if you invested into shares? How will your money grow over the next year, 5 years, 10 years, 20 years? If you bought property instead, how does that change the trajectory? And we always know every single time what the best strategy is going to be in terms of the one that will make you the most money, which is borrow as much money as the banks will lend you and load up into quality assets that will grow. Now, that is not the best strategy for most people, because you've got to be able to sleep at night. You've got to be able to manage your risk. You've got to manage the cash flow of that. But absolutely, without a doubt, that is the strategy that will build your wealth in the fastest, in the shortest amount of time. And on the flip side, and we talk to a lot of people that they're say that they're allergic to debt, or they don't like debt, and I get it. I don't really like debt necessarily either. I just like what it can do. And if you never take on any good debt to invest over time, you would be leaving a lot of money on the table.
Right.
Particularly, you save up, you buy a property, you pay it down, you've got all this equity there, you never do anything with it. I've got, people in my family, one of my uncles, a great guy, bought his house, paid it off, cash in a bank account, he got his nice government super scheme, thank you very much, refuses to do anything else, wouldn't do it. But he could have very easily purchased a modest investment property, made sure that he was comfortably buffered with cash so that there was no, real risk of anything happening, and would have hundreds of thousands of dollars more, if not millions of dollars more over time. And
you didn't give your uncle some free advice?
Oh, it's a dangerous path getting into that sort of stuff with family. But
well, it's hard. It's a lot of pressure. I expect, I suspect, to give people this level of advice. We're obviously not providing personal advice here today, but in general, in what you do professionally, how do you, I suppose, reconcile that pressure that comes with steering people in the right direction?
I tend not to when it's family and people in my circle. I've got a number of great other advisors that I know, and I tend to refer them out at least as a first step, and that way it keeps it a little bit more objective as well. But I have done a lot of education sessions with people that I do know, where they're working through a particular issue and just helping them understand what the considerations are around that as well. I find that that makes it a little bit simpler. You can give them a push in the right direction, and then when they do need formal advice, they can do that. But I take that responsibility with all of our clients in exactly the same way, that these are really big decisions that people are making that have a huge impact on your position today, but also how your trajectory changes over time. And so, I think it's a really privileged position to be in.
Okay, if I were to say the word crypto to you, what would you say in return? How do you describe it as an asset?
Oh, look, I think it's a really interesting space, fascinating actually, fraught with some challenges and a little bit of danger as well. But I think I think crypto has a bright future. I think particularly over the last 5 or so years, we've seen a lot of adoption of cryptocurrencies, Bitcoin being the largest one, by bigger companies. We're now seeing these strategic reserves of cryptocurrency by governments around the world as well. And so it seems quite likely that, thinking over the long term, that there is a permanent place for Bitcoin and other cryptocurrencies in the financial world. Thankfully, it's also becoming more accessible through ETFs and products that allow people to access crypto, but in a way that's a little bit more
traditional.
Traditional and regulated and protected than, we've obviously seen some high profile issues with crypto exchanges, and the space is evolving so quickly that the regulation, it really can't catch up. And it's also because it's an innovation space. It's there's a risk that the regulation will stifle the innovation, and so the regulators are in a difficult position around that as well. But look, I think it's super interesting. I think it's likely to continue to progress over time. I also think, though, that where people can go wrong with cryptocurrency and other similar sort of higher risk, high potential return investments like startup investing, those more penny stocks, or foreign exchange or trading, trading, like doing not high frequency trading, but a lot of people, that when they get into finance, they get this dream of, being able to retire at 23 and just trade.
FIRE, is that the?
FIRE's a bit more index fund investing, and
Right.
they want to retire early, but they're doing it through the, consistent, tried and trusted sort of methods. But a lot of people and like, I sort of got tempted. I traded a little bit of Forex when I was at uni. I thought I was onto something, and, made a little bit of money, didn't need that much money at the time. Then I quickly lost it all. And again, over the course of my career, unfortunately, I've seen quite a few people that have done that as well. And those sorts of investments, if you are really interested in it and you're really dedicated and you're prepared to allocate lots of time, you're prepared to make a few mistakes, cost yourself a little bit of money along the way, it's something that you can get good at over time. It's a skill. You can still get unlucky and lose a lot of money as well. But if you don't, which is most people, if you don't have the 8 hours a day that you want to be looking at markets or staying up overnight as big decisions are sort of coming in around the world, it is very difficult to do the trades and actually make money out of it. And so generally, when you're getting started investing, we're talking about those examples, replacing your salary, invest $10 a day. It's going to allow you to do that by 60. If you, though, blow up all of your cash at 5 years in because you're punting on the wrong thing, then you're going to have to go back to the starting line. And more than losing the money, you lose the time, which means that you're going to have to do a lot more in the future. And so the sort of overarching philosophy that I advocate, and I talk to our clients about this, and also through like our digital advice offering, is that you build a foundation first, get your first like sort of $100,000-ish in investments. And then if you're really interested, you can start to allocate a smaller amount, maybe 5% of the new money that you're investing into something like crypto or startups or whatever it is that you're actually really interested in. And then that way you can do it, but in a way that you're not jeopardizing all of the hard work that you've done to get there. When it gets to the point where you've got so much money that you're completely financially free, and then you've got an excess of money beyond that, which is the nice
That's the dream.
a nice dream to think about. But you could go to town with that sort of stuff, because you know that the money you put there could go to zero and it's not going to impact you. Like I've got some Bitcoin in my investment portfolio, but I treat it in that exact same way, that if it went to zero,
afford to lose it.
I've got I don't think it's going to, but it's not going to jeopardize any of the other plans that I've put into place. And I think that's how you want to be sort of thinking about those sorts of investments.
So if we're looking at a pie of investments in terms of how we allocate our assets across, our lives, what does the dream pie look like? How are we sort of effectively balancing where we're putting our money across, property, shares, maybe a bit of crypto, and whatever else you might put in there?
Yeah, look, it's a good question, and I think maybe in terms of answering that, it really sort of depends on what stage you're at with your money, what life stage, and also which financial stage. And when I wrote my latest book, I spent a lot of time sort of thinking about looking at our clients that were getting the best results and the ones at different levels and how that sort of comes together, and realize that there's actually sort of 5 key stages that people move through with their money. You start at what we call the foundations, where it's like you're putting the basic building blocks in place, and then you move up, and the final one is the position we were just talking about, where you've got more than enough money to live your ideal lifestyle, you're spending how you want, you're living in your dream home, etc. And then there's a few steps in between. And so the right allocation really depends on which of those stages that you're at. So in the early stages, you want to focus on your saving more, and then probably a little bit of share investing as you're building up towards getting a property deposit together, essentially. Then you get into the property market, and then it's about securing your savings capacity again, and then getting ready to build more wealth through smart debt, essentially tax effective debt. And so if you looked at what a pie graph would look like, in the earlier stages, you're going to be heavily skewed towards property more so. Although, as much as I love property and love using smart debt to build assets, I'm not an advocate that you need to have 10 properties or 20 properties. I think that that's a headache, and it means that you're probably taking on quite a bit of risk, or more risk than you need. And so it reaches a point where you've got enough in quality property assets that if you just let the property market continue to do its thing, you're going to end up in a really strong place financially with those particular assets. And at that point, what will happen is over time, the rents on your investment properties increase, the debt on those properties is reducing, and hopefully at the same time, your income is continuing to build and your savings capacity is there. And so at that point in time, you probably want to start tilting more so into share type investments and building up that side of the ledger, essentially. Because what a lot of people don't always realize or think about as much as they should is that property is a great asset when it comes to growing your asset base, growing your wealth levels. But it's not great from an income perspective. The net rental income, so when you've got an investment property, you get a bit of rent and then you pay, strata and your rates or whatever, that the net rental income across Australia on property is about 2.7%. On an Australian share portfolio, the income is generally about 5%, and it's a little bit more tax effective because of the dividend franking credits that you get when you receive income from shares in Australia. And so what that means is that if you have $1 million in shares and $1 million in property, you're going to be getting double the income from shares than you would from property. And so property is great as you're building up your asset base towards retirement. Shares are generally better when you're getting set up to start drawing that income from your assets. And depends on how strong your position is, because if your position is really strong, you can buy up properties and you never really need to sell them because you can just crank up your investments with your excess that you've got. But if you're someone that maybe you've done a few calculations or maybe a little bit of planning, and you're only just going to get to where you want to be, you probably don't want to be owning any property assets when you're in that retirement phase, because having your income in shares will give you a better and more tax effective income as well. So I don't know that there's a pie. Sorry, that was a
different pie for different stages.
Yeah, exactly
Great.
Right.
What about inheritance? Because there's a big trend going on now because of the economic climate, and a lot of older Australians being worried about how their adult kids are going to set themselves up for financial security long term.
Yes.
And they're starting to look at releasing some of their assets and some of their inheritance early.
Yes.
Of course, not everyone is going to be able to do that. Not everyone has more than enough saved for retirement. But for those who do, what are some of the common mistakes that people make on that front?
Well, yeah, look, it's a super interesting area, and we're going through the largest intergenerational wealth transfer in history. It's like trillions of dollars will be passed down from the boomers generation to the next. And I think given the affordability challenges with the property market, cost of living and all of those things, and the fact that older people are living longer as well, that passing some of those assets on earlier can give your kids a leg up at the time that they need it. Because if everyone's living till 100 now, it's like your kids are sort of doing all of the hard yards at that point, and then they either get through or they get to wherever they're going to get to, and getting an asset down the line probably doesn't have quite the impact as it did.
They're already out of the woods.
Exactly right. So look, I think that for any anyone that's considering going down this path, there's a few things to look out for. I think having good conversations around, what will happen now, what will happen over time, and, how pre-inheriting might change what you ultimately inherit as well. Understanding the tax implications is quite important, both for a traditional inheritance and a pre-inheritance as well. If parents are passing on investment properties or share portfolios, then that can trigger capital gains for them. And so, understanding what those are before you go too far down the path so that you can plan appropriately and figure out the easiest or most effective way to actually pass on that money is a good one as well. And then also just ensuring that there's a level of protections that you're putting in place around like bloodlining assets as much as possible as well. We see the instance of relationship breakdown in Australia and Western countries as well is relatively high. And so if you pre-inherit a big lump of cash and then you have a relationship breakdown, your parents can see, a big chunk of that money exiting with a exiting partner essentially. And so there are ways that you can protect against that outcome happening with the appropriate legal agreements and those sorts of things in place. Also, for a traditional inheritance, using proper estate planning lawyer with the right documentation, considering perhaps using even testamentary trusts, which are like trusts that are established on death that can be linked in with a family and again provide a level of asset protection, a lot of tax efficiencies as well. And just understanding those implications, because in Australia they say that there's no inheritance tax and there is no tax that's called inheritance tax, but inheriting super comes with tax obligations, inheriting investment properties comes with tax, inheriting share portfolios comes with tax. And so, the intention, I get really mixed sort of feedback when I put content like this online, that there are a number of people that say, well, tax is great and it's there and supports the country, and I 100% I sort of appreciate where they're coming from with that. But I suppose the counterpoint to that is that your folks or whoever is passing on money, that generally for most people that they've worked really hard to do that they're typically trying to pass on as much as that as they can to the person, rather than passing it through to the tax office. And structuring that in the right way does make a big difference there.
Of all the clips you've uploaded over the years, has one really taken off in a way that you didn't expect it would?
Yeah, well, the first one I think was the most interesting one for me, that I'd been posting for, I would say, well over 12 months at this point, and put a lot of time in, tried a whole heap of different things, did, content on investing series and, spent heaps of time on all of these different things, and none of them had really taken off or landed. And then I was doing a piece of content one night. APRA just released their statistics on the they do super fund rankings, and basically if you perform under a benchmark each year, then you get like a warning, and then if you do it again, you get basically blacklisted and you can't take on new members and stuff. This happens each year, and I was just saw the article popped in to my inbox. The kids were just about to have dinner. They were just like running around somewhere at home. My wife was out, and I thought I'll just quickly bash out a little video and talk about these stats. And halfway through the video, my daughter started screaming in the background. And so I quickly paused the video, and then I grabbed her and I put her on my lap, and I think she must have been only 1 or 2 or something at the time. And so didn't get any screen time. And so she was quite happy to see herself on the screen. And so I finished the video with her sitting on my lap, and I posted it and it got like 500,000 views. And
relatable, bro.
All of that effort though in all of these other videos, and it doesn't get anywhere near the traction.
People just want to see the real chaos of life, don't they? Sometimes.
Exactly right.
How has having kids? You've got 2 of them, a 6-year-old and a 4-year-old. I've got a 5-year-old and a 4-year-old, so we're very much in the trenches together.
Yeah.
How has having children changed your relationship with money, if at all?
Look, I think it changes your perspective a little bit as well, and particularly with some of the issues that we're talking about around affordability and how challenging it's getting for people to keep up, let alone get ahead, let alone be actually secure and comfortable. It definitely makes you think about that more. It pushed us to review all of our insurances, which we had a fair bit in place, but dialed that up a little bit when we had kids. wills in place for the first time as well, and so making sure we had everything sort of dotted and I's dotted and T's crossed behind the scenes. Also, we started investment accounts for I got 2 girls, for both of our daughters, and just doing consistent the $10 a day investing that I wish I was doing at 20, let alone at 2, and sort of just keeping that ticking over as well, and trying to sort of bring them into the conversation about money as well, and understanding it. I knew absolutely nothing about finance. I didn't know anyone that worked in finance. I didn't have any family members that worked in finance, and it was sort of by chance I got given Rich Dad Poor Dad, Robert Kiyosaki, obviously a pretty
That's the turning point for a lot of people, that book, isn't it?
Yeah, absolutely. My grandma my grandma had given it to my cousin, and he wasn't interested, so she gave it to me, and I started reading it, and that was where the finance thing started. But I was about 20 at that point in time, and I wish I was into it more. And so there's not a lot of resources out there, and there might be something coming down the line on that, but I wish that there was, because the values around money and the mindset with money is so powerful. And we see this with our clients as well. We talk to hundreds of people every month that are looking to engage with their money, and some of them just have like their belief systems, or I don't know the right sort of term to put on it, but you can see that they get so far down the path of this a particular way of thinking that they recognize that something is important, they need to do something, but they just can't bring themselves to do what needs to be done. And so trying to sort of normalize that and give our kids and the tools and understanding to be able to be aware that this is a thing and something that you need to pay attention to and learn about and respect as well. So I don't know that I've cracked the code there, but we're definitely talking about
Please let me know when you do.
My daughter likes seeing the little line. I show her the investment account, and she likes to look at the little graph.
So do I.
Yeah,
Girl,
exactly.
so do I. Especially when it's going up. Ben, you've been so generous with your time and your knowledge and your experience. Thank you so much for joining us today.
That's right. Great to chat.